We're live on LinkedIn, live on YouTube, and live in person, and happy to be here and happy it's Friday. Let's get started here. Hello, Smart Money Tree Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I will be your host. I'm once again joined with my good friend Doug Hagerin. Hey, Doug. Doug, you're muted. I'm sure it was really, really awesome what you were saying, but we can't hear you. Still can't hear you.
You know what?
There we go.
There's too many dang buttons to mess with here, Kirk. I had one unmuted, another one. But hey, look, it was exciting what I was going to say, because today it's going to be an exciting episode. I mean, the lottery, the Mega Millions, $1.25 million. Many
Billion.
people dream. Yeah, billion. Sorry,
billion with a B.
Many. Yeah, $1 million, and of course everybody's laughing at him. Like, really? Yeah. It's hey, listen, a lot of people dream about this. It can be a life-changing experience. Aren't that many people? Obviously, the odds of winning it aren't great, but it's always fun to dream. So let's talk about that today.
Yeah, we're going to dive right in, and at some future podcast, we'll go back to what Doug said, which I'm sure is the meaning of life, but we'll just have to wait to hear that. So let's dive right in. So big news this week: the markets did not go up. Not sure what happened. Did they hit a speed bump? Did what happened here? So let's kind of dive right in, because I think it's interesting, because the markets pretty much went up all year, and then all of a sudden this year, this week things went down, and people are jumping out of windows. They're screaming Harry Carey in the streets, and so let's talk about it. So last week the Fed raised interest rates at 25 basis points for the Fed funds rate. Wow, 25 basis points, and no one was surprised. Imagine that. We talked about that last week, how not a single person was surprised that happened. And yet the market yawned and went on its merry way. So what did happen? Well, apparently Fitch, and there are three rating agencies. There's S&P, Moody's, and Fitch. There are actually more. You never, ever hear about them. But they're actually, I think there's like 5 or 6, and they are, I believe you have to apply to get a license for it or something along those lines. You can't just be a rating agency. I think there's 5. There's a few more that people don't talk about as well. Anyway, the big three: Fitch, S&P's, and Moody's. I think it was S&P lowered the credit rating like a few years ago, and Fitch did it late. I think it was late last week. I think it was late last week, early this week. Anyway, so they did that, and people were just like, yeah, okay. Well, what was interesting was watching the markets overnight. So I didn't know about this until the morning, because they don't tell you these things. It just happened. A few people noticed, and they watched it overnight, and it was just a big snooze fest. Just the markets didn't seem to care, because I think everyone is on the same page with the Fed. Like we talked about last week, this was a surprise to nobody, and the actual downgrade was a surprise. But the fact that they lowered the U.S. credit rating because of, I think it was the debt ceiling concerns and too much debt. Wow, really? That was a huge surprise. Who would have thought that too much debt and the debt ceiling debate would have allowed them to lower their credit rating? Now, I don't think anyone's under the illusion that the credit rating of the U.S. is not pristine, but there are a lot of other countries with pristine credit ratings. Anyway, the point is the market actually cared this week. So the change in the credit rating actually caused the market to care. It didn't happen right away, but it did happen. And so you look at the NASDAQ, you look at the Dow, things kind of peaked out somewhere in the neighborhood of the 19th of July and have slowly creeped down. Now you might say, oh, is it time to jump out the window? Nope, it's not time to jump out the window. And I say this because people naturally think, well, the market's going down, it's going to crash. That is our human nature behavior of, oh, it's going to crash. Not necessarily. It could be just a minor correction, which is certainly highly possible. It could be the start of a greater correction. We just don't know. What we do know is that the market actually cared about the credit rating drop. And the reason that they started to care, and if you really kind of dive into what's happening here. And I'm going to pull up a quick chart, which I cannot share, but I will give you the numbers because it's in one of our systems that we're not I guess, allowed to share. So if I look at bonds, right, we look at bond yields, and really credit rating applies to fixed income or bonds more often than it does anything else. Now, if I look at the U.S. Treasuries, which are now considered AA plus, not AAA. So AA plus is one step down from AAA. Now there are, I think, 4 or 5 companies in the entire world that are AAA rated corporations that had the credit rating of what the U.S. used to have. There are like 4 or 5 right now that have that. There, if you were to get a bond for a AAA corporate for 1 year or less, the best rate you can find is 4.75%. The best rating on a U.S. Treasury for 1 year or less is 5.4%. Now, what can we take away from this? Now, I'm bringing this as an example because we can learn a lot from this. Now, what tends to happen is the yield or the interest rate that you're getting if you buy a bond is typically tied to the credit worthiness of this bond. So in this case, the U.S. Treasury is paying 5.4% for treasuries under a year, and the AAA corporate paying 4.75 technically percent. The people are looking at that corporate bond as a more reliable repayer than the U.S. government. That's effectively what that means. So people are pricing it as the U.S. government could default, so we want to get paid more, 5.4%, than a AAA corporate, which they're looking at as a very low risk of default, less of a risk than the U.S. government of defaulting. So we will accept a lower interest rate. Think about that for a moment. There are a handful of companies in the world that have a better credit rating than the United States of America. That should give you pause. Now, I'm not saying that's true, right? I'm saying this is what the market perceives to be true. There's a difference, right? The truth is, at least for the foreseeable future, the United States government can print as much money as they want. The world will object, but you can't default as the global reserve currency. Now, if we got to a point where it was crazy, which I would argue we're probably on the borderline of crazy, you could argue that other countries around the world might say, you know what, we don't trust you guys, we're going to do our own thing, which is actually what they've been doing for the last 10 years. The Belt with the Belt and Road Initiative, you've got a few different Asian PAC, I forget what they're called, but basically Asian regions are doing trade agreements with each other, trying to do trade in their own currencies instead of the U.S. dollar, which was globally accepted as the reserve currency. So everybody did their trades in U.S. dollar, and we got a lot of power from that. And that's one of the meanings of being the global reserve currency. A lot of countries are saying, you know what, we're just going to do it in our own currencies. We don't trust you guys anymore. That is slowly whittling away our power as a global nation and as the policeman of the world. You could argue whether we should or not. That's not the point. But we are seen that way. That is our position of power. That is slowly getting whittled away until the point where actually our credit rating will matter. And at that point, I would say, given the numbers that are outlined, we talked about last week, we're all screwed. So we have to, as a country, be more responsible fiscally than we have been. And eventually that will matter. For right now, it doesn't matter for the foreseeable future. So for a year, I feel very confident that the U.S. government is not going to default in the next 12 months. Very, very confident in that. 10 years, 20 years, I don't know. 1 year, I feel pretty confident that we're not going to default. So people don't agree. They think that AAA companies, some of these companies, at least one of them, have a better opportunity to not default than the U.S. government. That should tell you something, right? Market participants around the world, the best and the brightest, nuclear rocket scientists, nuclear physicists that are working on Wall Street, really smart people agree that, yeah, I'd rather invest in this AAA corporate bond than the U.S. government. So if you think that we're not being responsible as a government with our financial situation, the best and the brightest disagree with you. So just something to think about. But I did want to point that out because that that started that the thing that I just kind of mentioned was part of it. There's also the fact that if you look out further on the curve, what we've been noticing. So I talked about a 1-year bond, and I'm trying not to put everybody to sleep with this bond talk, but let me just finish up this point because I think it's really important if you want to understand why the market dropped this week. So if you looked at the bond yield curve, what typically would happen is it was high on the short end being like, 1 year, 2 years, something like that, and lower on the long end, which would be 10, 20, 30 years. So that's what we call an inverted yield curve, which means it's higher in the short end, lower on the long end. Normally, in normal environments, which we haven't been in for a while, it would be lower on the short end and higher on the long end. That is a normal yield curve. That is a normal marketplace. That's when things are functioning properly. Things are not functioning properly now. But what has happened through this downgrade is the long end of the curve, which means 10, 20, 30 years out, those rates have been climbing. Now, I would argue that 10 to 20 years from now, I could make a really good argument that the US could default on their debt in 10 or 20 years. I'm not saying it's going to happen, but I'm saying I could think of a really good argument right now. And I don't want to scare everybody, maybe in a later episode, but I could think of a really good argument of why that could happen. So everybody else is thinking the same thing. So the long end of the curve, the yields are creeping up, creeping up, creeping up, until at some point they're going to flatten out right around where we are, and maybe even go higher if rates stay higher for long enough. That's actually a good thing. It's a good thing in the sense that it's a normal yield curve. It's a bad thing because everyone's going to have to pay for that, right? That means the interest rates on your real estate is going to be higher, interest rates on your corporate bonds is going to be higher, everything's going to be more expensive. So it's a problem economically, but from the standpoint of how the markets operate, it's a little bit more normal, and it seems like, all right, the wheels aren't coming off the bus at this point. The big problem with this, and I'll just point out because we haven't seen much of it yet, is with interest rates climbing, we're going to see more bankruptcies, more defaults, and frankly, you might even see more bank problems because the banks like Silicon Valley Bank that went under, the bonds they had started to lose value. Well, a lot of these banks own 3, 5, 10-year bonds, which are now the yields are creeping up, which means they're going down in price. So if they need liquidity, you may see more bank defaults. I'm not saying it's going to be imminent because I think I'm not seeing any signs of it being imminent, not at all. But if we had some sort of liquidity or a bank run or even a sense of things not being square, we might see some problems. So just want to point that out before we get into the big lottery. Doug, you have thoughts on this? I know you probably have some good thoughts on this.
Yeah. I think Kirk, one of the things with regards to the banks, I mean, I agree with you. I don't think that we're going to see anything of concern anytime soon because we've already seen some very potentially disastrous repercussions of that short-term regional banking crisis over the last year. And what happened? Crickets, right? Because the federal government, we talked about this before, but the federal government basically went against its policies and brokered some deals and situations that allowed these banks to be able to be acquired or be able to now be able to borrow from a reserve of reserves in order to get through these liquidity crises. And that's something that if there is going to be some isolated circumstances where run-ons could occur, that I think, the government just said, look, and proved to us, we're going to make this not get felt. It doesn't really solve the problem, but Kirk, I think you can agree with me. The government's done a really good job, at least over the last 15 years. Looks like I'm having some sound issues. I don't know why, so pardon me on this one, because it shouldn't be.
You could take care of it when you're done with your thing, Doug.
Yeah.
It
But
sounds like it's coming from another
I need to
mic.
make sure because it's literally right in front of my face. But
it's not coming from the mic. The mic is probably somewhere in here somewhere. So just FYI.
Regardless of the case. So I think the issue the issue that we're seeing here is that if it's an isolated case, government's going to take care of it. What happens is if we start to see a compounding onslaught of those circumstances, there's only so many things that so many banks the government's going to be able to step in and lend to at once. And I think if we know that when we looked at some of the data previously on these banks, many banks were at a potential risk of having liquidity issues based on the treasuries that they were holding on to. And yes, now there has been some warning signs that will hopefully help these banks to be able to be able to maybe start to try to deleverage that, but but the markets are only going to absorb the liquidation of those as best they can, and a lot of these banks are stuck with that issue. The other thing you talked about, with regards to what we've already seen over the last decades, with regards to the debt crisis. Look, I think a great example. You talked about 4 or 5 companies in the country that have better credit ratings in the United States, and you touched on it. There's one thing that none of those companies can do that the United States can do, and that is print money, right? So, if a company runs into a credit cycle, I mean, you're talking about higher borrowing costs, market reaction, investor confidence. Nobody invests in the U.S. I mean, yes, U.S. Treasuries, but it's not quite the same as buying a stock. Operational and strategic adjustments. You're talking about impact on business relationships, reevaluation of financial strategy. GE is the perfect example of this. GE got a notable credit downgrade. They've had a couple of them. The last one, I believe, was 2018. And GE used to be one of those companies that had a perfect credit rating, and they used this to, almost in a very strategic way that would, for a long time, help GE make tons of money by being able to use their low borrowing costs and then lend out to others at a higher rate. And that's where they really became one of the preeminent financing companies that were out there for big ticket financing, like airplane leasing. Unfortunately, that became a problem for GE after 2008 and beyond, when they became too stretched, too leveraged, and eventually they were forced to have credit downgrades that made their borrowing costs higher, and that ultimately put them in a very, very poor position. And they had to deleverage a lot of that financing that they were doing. And unfortunately, today GE has been, has been split apart. I mean, the company is not the company that it used to be. You also talked about Currencies and how they face, how the United States is going to be able to get through this, being the global reserve. You did mention the one thing when you talk about some of these agreements that you're seeing in like third world countries. Those are known as bilateral currency agreements. Those have been going on for a while to facilitate trade and investment without relying on the U.S. dollar. There's been more internationalization of the Chinese yuan. There's also been alternative currencies, the rise of Bitcoin and digital currencies and blockchain technology. And the euro for a long time, we can go back even further than 10 years. The euro was one of the first steps to try to counter the power of the U.S. dollar on the global scale. And when the European Union got together and all of these individual countries decided that they were going to forego their own individual currencies for the collective good of Europe by creating the euro, well, the euro has been worth more than the U.S. dollar for the majority of that time frame, and was the first international. I mean, it itself was a bilateral currency agreement amongst European Union members, but it was really the first step in trying to counter the U.S.'s position as the global, currency monopoly. I mean, so like you said, we've been seeing this, but I think longer term, this is an issue that the United States. I mean, hopefully it's a flag that says to the United States, we have to do something about our own financial government spending. Don't think that's going to happen. We know there's political issues that are going to continue to be headwinds there. But the last time the U.S. got downgraded, I think it was 2011, and it was the exact same reason. Once again, the U.S. government is printing dollars. The dollar is it's put at risk. Yes, it's considered still the main safe currency, but yet at the same time, we get to these points in which we have a debt ceiling that is a mandatory debt ceiling. We cannot outspend that debt ceiling without agreement between between in the legislature, and both times the legislature took it down to the wire and got into a political battle threatening letting the U.S. default. And we've gone into government shutdowns previously. We've gone into we've run into this issue before. It is something that nobody wants to see, but as long as they feel these credit ratings feel that there is a risk there that the U.S. is going to have political divide that's going to allow the U.S. government to shut down. Yeah, that's not necessarily something that builds international comfort, and I don't see that thing improving. With the next debt ceiling agreements that are going to happen in the future, and this is a warning. This is a warning flag to say, look, get it together because we're watching you, and the rest of the world is concerned.
Yeah. All right. Well, let's dive right into the exciting things. So one thing we want to talk about today, which I think is going to be instructive, is there is a $1.25 billion lottery prize for what is it? Mega Millions. Mega Millions is what it's called. So 1.25 billion with a B, Mega Millions lottery prize. So those of you listening live, run out and spend all your money on lottery tickets, right? Great investment. Well, sort of. So let's get into some of the pieces here, and we're going to talk about how to think about it, because I think this is going to be really important. So if I look here on the screen, and for those of you listening, you just have to bear with my muttering here. But if I look at this, so this is right off the website, okay? If you match the mega ball or whatever they call it, you win $2, and there's a 1 in 37 chance that you will get that number correct. Getting the mega ball plus one match is 1 in 89 chance of getting it right. Right now, you keep going all the way up to getting a match of 5 plus the mega ball. You win the jackpot, which is 1.25 billion. The probability of getting that is 1 in 302 million and change. So basically, if you bought 302 million and change tickets and you were the only winner of the jackpot, then you would effectively you'd spend all that money and you'd get 1.2 billion back. Obviously, if you don't include tax. But I'm not an accountant, but I'm sure you could write off those tickets as part of the expense. Now, what's interesting is, there are people who actually do this. There are people who go out and run the numbers and the math, and they'll go out and they'll print like millions and millions of tickets because they know the payoff is going to be worth it. And the payoff in this case might be 2 to 1, right? If you bought all the tickets and you spent $302 million on tickets, and the payout after tax or whatever ends up being like 600 million, then actually you get 2 to 1 winning. Except for the fact that what if another person wins? Now that's no longer a viable thing. So I point this out because there's a lot that goes into lottery, and we're going to get into the psycho-emotional side of it too, because that's actually really important. But I just want to kind of throw this out there because I find it interesting that the lottery has gotten this big. Inflation must be going crazy, because the fact that there's a over $1 billion prize is pretty crazy. Now, what are your choices at this point? Well, let's say you win. Let's say you're the lucky bloke who wins. Obviously, I would ask for my piece for encouraging you to go invest in the lottery. This is not investment advice, by the way. But if you go and win, and you want to donate to the Money Tree Investing Podcast Fund, I'll happily accept. Anyway, the point is, if you go out and win, you've got a few choices. Now, you'll probably be pretty excited. B, I would ask, and Doug will get into this too. There's actually a lot around this, because I want to talk this through, because it's like, hey, I won, and go tell all your friends and family. My dad always told me when I was younger, is if you ever win the lottery, don't tell anybody. And Doug will get into this. So, but before we get into the emotional side of it, let's talk about it. So you have a choice. You can either take the $1.25 billion over, I think it's 20 years. I think there's a 20-year period. I have to look it up, but I believe it's 20 years. So that can be paid out over 20 years, which comes out to somewhere in the neighborhood of 65 million a year over, I think it's that number. It's weird. Comes out over 20 years. Or you could take the lump sum payment. Now, the lump sum payment is not 1.25 billion. The lump sum payment is 625 million. You might think, well, wow, why don't I just take that? That's a lot of money. Well, we haven't accounted for taxes and all the other stuff that comes out. So your net at the end of the day might be somewhere depending on the state you live in, because there's state taxes, it might be somewhere in the neighborhood of 350 to 400 million dollars net after taxes in your pocket, which is still a pretty good amount, but it's a heck of a lot smaller than 1.25 billion. So the question is, well, which do you take? Do you take the 1.25 or you take the 625? And there's a lot that goes into this, and I'm going to lay it out and I'll let Doug get into the details. But there's a few different pieces of this. One is, if you took all the money up front, what would you do with it? Would you go buy a big house for that amount, or would you buy 100, 200 cars, or are you going to do something stupid with it, or are you going to take this as an opportunity and say, all right, what can I do to make my life better? Now, some of the most successful lottery winners over the years have been people who didn't change a thing in their life. Money did not change who they were, what they did. They still went to work the next day. They didn't treat anybody differently. It was just the same every single day. Those are the most successful people. Some people, what they'll do is they'll expand what I call like their financial ecosystem. So let me give you an example. So I wrote a paper on this years ago comparing lottery winners to professional athletes. And you might think, well, they're not the same. Well, they're actually very much the same. And I'll let Doug talk and I'll get into the statistics. But they're very much the same for the same reason. You're accustomed to a certain financial ecosystem, which, let's say for this example, it's making $50,000 a year. And you win the lottery and you take home before taxes $625 million. Well, you probably don't have more than whatever, like 10 grand, 20 grand saved. Now you've got 625 million. That's going to change your life, right? You're probably thinking, well, I deserve this. I won this lottery. I deserve to spend this money. That's mine. I'm going to go buy a big house. I'm going to go buy a condo in Las Vegas. I'm going to buy a condo in Hawaii. I'm going to buy this. I'm going to buy that. And now all of a sudden you've spent a few million bucks, right? Which is a drop in the bucket compared to the 625. But that few million bucks actually has costs associated with it. Your cost for having a condo in Vegas. Well, you got condo fees, right? You got taxes. You got a big house. You got taxes. You got cap expense. You got all this stuff tied to your stuff. So now instead of your expenses maybe being 40,000 a year, now your expenses are like $1 million a year because you have more money. So you're expanding your financial ecosystem. Now the problem is when people don't acclimate to that slowly, it blows their financial ecosystem out of whack. So if you've got, let's say, a professional athlete that was making nothing, right? They went to college, they didn't make any money, and then they got drafted. Now they're making, $20 million a year. Well, now they've got an entourage. Now they got to go out and party all the time. They need a big house for their mom. They need a big house for themselves. They need to drive a fancy car because, hey, I'm an athlete. I need to look good. And they spend all this money and they're making 20 million a year and they're spending 20 million a year. And then 5 years later, I guess depends on the sport, between 2 and 6 years on average is how long they last. Let's say 5 years later, they retire. They spent all their money. They have no money left. What are they going to do? Well, now you got to go to work because you spent all your money having a good time. Realistically, you don't need to spend all that money to have a good time, but you don't know that because that's your ecosystem. You're making 20 million a year. You can spend whatever you want. You don't have to be responsible. Once you have to start being responsible, all of a sudden you never built up those skills of being responsible. So now you don't know how to be responsible because you got 20 million a year as an 18-year-old, and now you're 25 and you still haven't built those skills. And now you don't have any money. So now you got to go to work. So now you got to build the skills like everybody else. So I've seen this time and again, and it's really sad to see. And I'll get into the numbers after Doug, but I wanted to kind of lay this out because I think while winning is great, it can change your life. Most people, I would say, depending on the statistic, it's somewhere between 60 and 73% of what I would call lottery winners, which I include people who get in the state, people who play, are athletes, people who come into a big sum of money quickly. I call the lottery winners. 60 to 73% of them are bankrupt and or divorced within 2 years of winning. That should tell you something. And that's with everybody. That's not just this group or this group. That's across the board. 60 to 73%, depending on the sport or the way they came about it, have this problem. So, Doug, why don't you kind of dig into this a little bit more, because there's so much that goes into this.
Yeah, and there's so many fun things to talk about. First thing I want to start on is I want to start on the fun side of it. I threw a couple of images in there that I think are really telling. So I know you live in Massachusetts.
Massachusetts, yes, I do live in Texas.
Massachusetts, yeah. So I actually went and did the calculations. Of $1.25 billion would end up with a $650,000 lump sum payout. So what they're doing, and so if you take the lump sum, they're taking the net present value of what they think it could grow to if they took it over time. Now, if you took the annual payments, you would get the full $1.25 billion. Okay. They immediately have to withhold 24% federal tax. So on the lump sum, you're going to lose $156 million in taxes right off the top. On the annuity payments, you're going to lose about $300,000 over the course of it. And it's a 30-year payout. Now there's also going to be additional tax that you're going to have to owe up to the 37% tax bracket. So you can expect another $84 million that you're going to have to pay. This is a problem for a lot of people that end up getting these big lump sums. There's plenty of stories that talk about people that forgot to pay the taxes or tried to get super creative on how to shelter it. And the IRS has won many of those cases. So you got to be prepared right off the top that there's going to be another $84 million that you're going to have to write a single check for based on the year that you won this lottery. Now, if you get it on the annuity payouts, it's actually going to be a total of $160 million that you're going to pay. And then if you live in Massachusetts, you're going to write another $32.5 million in taxes, or have $62.5 million over the annuity payout. And that leaves you with a net payout, if you take the lump sum, of only $377 million. I mean, I know it's suffering, it's food lines, but I mean, it is a little bit shocking to see that on a $1.25 billion lottery, you're looking at only $377 million that you're gonna receive after taxes. An annuity payout would give you a total of $726 million that you would receive after taxes. And that sounds much, much better when you look at the numbers side by side. It's a $350 million difference. But here's the thing. You're getting that money today. Now, I know there's going to be spending that's going to happen, whether you receive the money once or over time. And so we're going to take that out of the equation and just assume that you could get that money, never use it, and sit on it. So which is better, taking the payments over time at $726 million, or getting the lump sum for a lot less for $377 million? Well, I also put into calculation over that 30-year time frame what you would have to receive in interest or growth on that $362 million net payout to achieve, or what would it be if you just got inflation at 3%? And if you were able to get that collecting 3% over the same 30 years, you'd end up with $880 million. So you can definitely have the money in a lump sum outgrow at a very conservative basis what you'd end up getting in a net amount if you took that money and got it over lump sum. Now, granted, there's going to be tax on that as well, right? So if we took it the after tax, it's probably going to be comparable. But from a standpoint of growth, you're really looking at to equal the same future value. I mean, the lottery is assuming, based on the net present value to future payments, they're only looking at about 2.5% growth on it if they were to keep the money and give it to you over time. So from that standpoint, it makes a lot of sense. Now, one thing I thought was very interesting, because I plugged in Massachusetts, I plugged in Minnesota, where I'm at. Minnesota, unfortunately, would take a little bit more. So you're looking at, about $32 million in taxes in Massachusetts. You're looking at a nice, cool $47 million in taxes in Minnesota. So I went and said, well, let's go take a look at one of the highest tax states in the country, California. And I was shocked to see zero across the board. It actually is one of those rare circumstances, kind of like their property tax structure, where California has a very interesting and beneficial tax code. it is actually tax-free to win the lottery if you're a California resident. So for one of the few areas where you can receive a massive lump sum of income and wealth is California, and it's actually tax-free. So if you're in California and win this, congratulations. You are effectively in, I don't want to make too many California people upset or vice versa, but it's like being in Texas. So it's tax-free. So, that's certainly, if you win it, congratulations. I know the Californians in Texas are very upset that I compared them at all at this moment.
They're kind of becoming one of the same, Doug. All the Californians are moving to Texas, so they won't be offended.
That's a good point. At the end of the day, Texas will be overrun by Californians anyway, so it isn't going to matter. But this comes back to the behavioral wealth side of it, and you mentioned some very, very important things, and I think that the first thing is, what should you do if you win? If you're lucky enough to win it out here, there's some really good things. First of all, stay calm and keep the news private. A lot of people want to announce it publicly. Now, there is, I don't remember the exact statistics. I don't know if it's 50-50, but about half the states in the country, you can remain anonymous if you win. And the other half of the states, you have to declare that you won. So it's going to be very, but even so, you don't have to declare until you get your matters in order. There is a time frame. I don't have that in front of me, how long you have to before you declare your ticket. But take your time. Don't announce it. Make sure how you're going to handle these new circumstances. Validate the ticket, because there's going to be nothing worse than finding out that you thought you won and then you didn't look at the numbers right. That would be, they say it's better to have loved and lost than to never have loved at all. I would say with money, it's much worse to have had money and lost it than it is to never have had money at all. So emotionally, it's very traumatic. Make sure you get your legal and financial advice, lined up, a team of professionals. You're going to have incredible complexities. Again, choose between the lump sum and the annuity. Develop a financial plan. This is really, really important. Taxes, charitable giving, investments, long-term financial goals. You might want to pay off some debts, especially high interest, non-collateral debt like credit cards or personal loans. May not necessarily be the case that you want to. I mean, if you've got a 2.5% mortgage, you might consider not paying that off. You'll have plenty of cash flow to do so over time. Create an emergency fund, invest wisely, set a budget, think about estate planning, because you're going to have incredible complications with regards to multi-generational planning. But that's also going to include philanthropy, giving, but be very cautious about making lifestyle choices that have impulsive, extravagant purchases. Maybe if you've always dreamed of having a piece of land, or maybe a place on the water, maybe that's something you go do. You're going to have that flexibility. But a lot of these lottery winners that Kirk was talking about that lost money, and ran out of money and lost their savings from these, it's often the same things. Buying cars, buying yachts, a lot of material goods. In fact, one of the more famous or one of the larger lottery loss stories out there, the person immediately went out and bought a 2-engine plane and didn't even have a pilot license and no intent to ever get one. I mean, this is just what happens. It becomes so easy. You're also going to have people that are going to come out of the woodwork. Family lawsuits from extended family and friends can often happen. So you need to guard. Again, you become a target for things like potentially kidnapping and ransoms and other types of extortion that can happen, which is very common with the high net worth. So guard your personal information, protect your safety. You can definitely end up with unwanted attention. You got to learn about taxes. I already mentioned it. They're going to take a ton of taxes. And a lot of people think, that one of the nice things about automatic withholding is you don't have to think about it. But unfortunately, it only goes up to a certain level. So as I said there, you might have another $80 million you've got to write. It has been countless stories of people who've just gone out with new wealth, spent all the money, and then got the tax bill later. And the government doesn't care that if you plead, oh, geez, whoops, I forgot. It's a real problem. And mentally stay grounded. Right? It's a fortunate event, but it does not define your entire identity. Focus on continuing to have meaningful relationships. Lots of stories like Kirk talked about: divorce, people going out, having affairs, mistresses, or finding relationships where people were able to, wiggle their way into your life and there's some incredibly talented con artists out there that are there looking to pretend that this is a meaningful relationship. But again, they may just be lining themselves up for your dollars and cents. There's a joke I like to tell. It doesn't make enough sense to equal dollars, right? And that's some of the things you have to think about with this relationship, where to come from. So stay true to your values, finding purpose, the things that you loved before you had money. Maybe this gives you the freedom and chance to go do those things, but remember what it was that mattered to you. And that's why Kirk was saying a lot of people, they go in the next day and they still go to work, because that's where their relationships were before they had money. A lot of people, they work with people that they build relationships. When you're growing up, a lot of your relationships that you have were built through school. And then when you go to college, again, still relationships through school. When you get out of school, a lot of those relationships that people build are through work. That's a whole different story when we start talking about the increase in remote work and what that's doing. But again, if these were the relationships you had when they knew who you were for who you were, those are going to be true relationships you're going to have later. And I think those values are really critical. And remember, you can always take your time anytime. So, I'm not just talking to lottery winners here. I'm talking, like Kirk said, to, the biggest number of lottery winners in this country are the people that start making a lot of money through, again, these days through content creation and social media, or the people that start to get these windfall checks that come through athleticism, right? This is more likely, although the odds are very, very low that your child is going to have the skills to be a Major League Baseball player. It's more likely that they're going to have that path than you are to win the lottery. So I'm speaking to all of you. You don't have to make all of these decisions immediately. Take time to make well-informed choices. There's a great story about Manny Ramirez when he got into, I think he was playing for the Indians at the time. I forget who told the story, but he was still driving the car that he had before, he got his multi-million dollar contract. In fact, he had to have some of the other players that were playing with him actually give him some guidance, because he had uncashed checks that he was carrying around that were in his car and in his apartment. Nothing changed for him. He wasn't even cashing the checks. He never even thought about the wealth. Now, that would be the extreme, side of not planning, but, he wasn't going out there and blowing it. Another great story that I love is what happened with Bobby Bonilla. Bobby Bonilla signed a 5-year contract worth $29 million in 1991. It was one of the richest contracts in sports. He spent the first 3.5 years with the Mets. He got traded away to the Marlins, won the World Series, got traded back to the Mets. Now the Mets, this is another story for another day, Kirk, they were very confident that they were going to make a ton of money with a gentleman by the name of Bernie Madoff. They ended up owing Bobby Bonilla, when they released him in 2000, they still owed him $5.9 million. And because they thought they're going to make all this money with Bernie Madoff, they actually agreed to defer his salary with an 8% interest and spread the payments over 25 years. Turned out to be one of the greatest decisions in history. Obviously, the Ponzi scheme fell apart. Bobby Bonilla's $5.9 million with interest swelled to $29.8 million from 2000 to 2011. So the Mets were on a massive hook. Now take that 25-year payout that he was due, and that equals $1.9 million a year that he is going to get. And I think he's going to continue to get that money until something like 2035. So, yeah, so exactly it. He's getting $1.9 million since July 1st, 2011. His annual payments are going to go until 2035. That's, when he's 60 now, he'll be 72 when it ends. He's never going to run out of money. And I think this is another planning conversation about why sometimes for some people, taking the annuity isn't necessarily a bad thing, because if you have terrible money management skills, which a lot of athletes do and a lot of people do in general, you blow that money this year, the next year it's going to come. I have a lot of retirement planning conversations with individuals. You'd be surprised how many are happy that they don't have all their eggs in one basket, that they don't have just maybe that big pot of money that's just in the S&P 500 that a lot of, FinTwit likes to push. They might have a pension, or if they don't have a pension, maybe they created their own asset-backed pension through an annuity. And all of a sudden they wake up January 1st and they've got more money coming in. And it doesn't matter what happens to the market, that money's there. I'm going to leave one last story, another one I love. Allen Iverson. So Allen Iverson, one of the most talented basketball players in NBA history. And this, I'm looking here, this was in 2020. So now he's going to be 48 years old. And he got to an important milestone in 2020. It was the 10-year mark for when he could collect a $32 million trust from Reebok. So he signed a lifetime deal with Reebok that guaranteed him a $32 million trust when he turned 55. So they forced him, when he got this deal, to put this money into the side and not get paid out at once. And now Iverson, like a lot of athletes, and there's a ton of stories of NBA players and NFL players specifically who have run out of money, okay, because they spent it, they blew it. I think, I'm trying to think of the Minnesota Timberwolves player that had Latrell Sprewell is a famous example of that. Well, with this deal, Iverson is getting an $800,000 salary that's going to be continued to be paid upon with this from the deal from 2001. He's going to get a $32 million trust on top of it. So Iverson did go out and spend and blow a lot of the money that he made when he was playing for the NBA. But now he's going to have this amount of money that's going to come in later that came in, because this is about 2 years ago that this $32 million trust became available to him. But it's going to guarantee him a second chance of the money. And there is a fact that, as we get older, we get more mature. So a lot of times you hand a 25-year-old $30 million, they're going to think the way an 18 or a 25-year-old think. And we've talked about this. The human brain does not solidify in its its maturity until about 27 beyond. That's why most crimes are created, are happen for people between the age of 18 and 35. So when someone gets to be 45 and 55, there tends to be a little bit more conservative approach to everything in life. And in many cases, that can also be a more conservative approach to how they handle financially. And that's why you see a lot of people go back and actually start to get concerned and worried about retirement when they get into this kind of 40s and 50s range. They're finally having this mature thought of, oh my gosh, maybe I better save more, that they don't necessarily have when they're in their 20s and think the world is, and their life is going to be forever. And if you want to read more about how that works, go look at the Retirement Mindscape. Look it up on the internet. Ken Dykewald put this together. I've talked about it. But there's about 5 stages of retirement planning. But it's that stage, kind of within 10 years of retirement, the people start to get, stressed and worried. So there's a maturity that's happening.
Let's come back to that, Doug, because there's some stuff I want to get to before you wrap up. So
absolutely.
So I want to get into some things that Doug was mentioning about professional athletes. So I did a research paper maybe like 5 years ago, and there's actually very sparse research out there, but there was some. And so Sports Illustrated did some research, and they came up with some stats, which I thought were interesting, and there were a few other people who did, so I want to kind of lay those out. So Sports Illustrated said by the time they've been retired for 2 years, 78% of former NFL players have gone bankrupt or are under financial stress because of joblessness or divorce. And within 5 years of retirement, an estimated 60% of former NBA players are broke. Now, that's from Sports Illustrated. That stat actually, it lines up with some of the other stats that I've seen as well. So if you look at if you look at lottery winners, the National Endowment of Financial Education cites that 70% of people who suddenly receive large sums of money will lose it within a few years. So I point this out because you've got 2 separate sets of people. Now, you could look at athletes, right? They're 18 years old. They're making $20 million a year. You could argue that, all right, they're stupid because they're 18. They have no life experience, right? And you can make that argument. But the NEFI says 70% of people. So if you're 50 years old, you have the same problem. So it's a human nature problem. It's not an age problem. Now, I want to point out some interesting things, and then I want to give some other advice on this as well. Some interesting things I saw. So I looked in, did some research. At the time, I said, all right, what is the average salary of professional athletes? They have an average career size. Every sport's different. NFL, the average career is about 2 years. The NBA at the time was about 6 years. And then you have baseball, I think it was like 4 or 5, and hockey somewhere in between. So if you look at all the different sports and you kind of lay out, all right, how much money are they making over their career, over that, let's call it 5 years. Let's say they make $1 million. I don't have the math in front of me, but let's say they make $1 million over 5 years. So that's $5 million. And you compare that to the working stiff, right? 18-year-old for 5 years makes $5 million. At the age of 23, they have no more earnings potential. Okay, they make no more money. So they take that lump sum at the beginning. You compare that to the working stiff who makes, a certain number. I took the median income of the U.S. I didn't take, crazy wealthy people. I took the median income of the U.S. and how much people reasonably should save. You compare those two, they're identical outcomes, assuming nobody does something really stupid. So if you take that 5 million at the beginning, you grow it over time, you compare that to the earnings potential, which increases over time for the average working stiff. At the end of the day, they're both going to have a very similar amount at retirement. Weird, right? You think, well, these people are wealthy. The problem is, it's not that. It's not that they're making different amounts, because they're making very similar to the same amount. The difference is the athlete is making $5 million when they're 18 to 23, when they're financially stupid, right? Like we all are. They're not different. Like we're all financially stupid at that age. And they want to go out and have a good time. They don't realize the value of money at that stage is the same as everybody else. So technically, they're not wealthy at that stage. They're just like everybody else. And if they realize that actually, if you take this money, it would last me the rest of my life and I wouldn't have to work, that all of a sudden changes the equation. And then these people aren't going to be going running around spending money on entourages. I don't know if you've ever seen the movie, the show Entourage on HBO. Great show. It was all about keeping your old friends because they trust them. That's what a lot of these athletes do, because they don't trust people when they have new money, which is smart. But the reality is most people become divorced and broke, bankrupt within a few years of winning the lottery, whether it's sports or the actual lottery. So I saw Magic Johnson speak at a TD conference a bunch of years back, and he was talking about some of the things that he was doing. He was trying to teach the youth coming up through the basketball system on how to be good stewards of their own money. And I think this is a problem with all athletes. And I will say this one point: football players are probably some of the worst at money, and actually they make the least of all the professional sports, which is weird. Shortest career, make the least, and they end up spending it. They end up spending it way more, and they end up broke. Tons of professional NFL athletes are broke. Baseball is next, and then basketball. Basketball, they have a longer career and they make more money. What's odd is hockey. NHL athletes, I couldn't find more than one NHL hockey player who filed for bankruptcy. Now, I'm sure they all have marital problems, because many athletes do, but oddly enough, the hockey players do not have this same problem. Now, I've been thinking a lot about this, and I have a theory, and it's just a theory, so bear with me, because I played hockey through college, so I have some insight into the culture. And my theory is that the difference is, if you're playing baseball, if you're playing basketball, or you're playing football, the parental involvement in the sport is a lot less, or at least it used to be. I know more now is different, but growing up, if you played baseball, football, or basketball, you didn't need a parent to truck you around. You just went out and played. You could play with, your local school. Hockey was different. Hockey, your parents got to truck you around to every rink every weekend. You're going up to Canada. You're going to different states. You spend a lot of time with your parents. And that parental involvement or oversight, in my opinion, plays a big role into the culture of hockey players and makes them maybe not more responsible, but it allows them to maybe not get so crazy when they have success. And so I think the parental involvement plays a large part of this. I could be wrong. Like I said, this is my theory. I wasn't a professional athlete in any of these sports. I didn't play all the other sports, but just from conversations I had, that seems the most logical approach, is that the parental involvement in the child's life played a bigger role in them being more responsible human beings growing up. So that's a totally separate issue, but that's kind of my thesis. Anyway, I want to get into what Magic Johnson was relaying, and he actually um, he talked about how to improve their financial stability, and he gave a few a few things that were I guess good simple solutions for athletes and lottery winners that everybody can learn from. So the first thing he said was get a mentor. You might think, well, what do you mean get a mentor? Well, if you're 23 years old, or even if you're 40 years old, and you come into a lot of money, you probably have no idea what you're doing, because I'm not saying you don't earn it, but getting it all at once means you didn't earn the mental skill of what most working stiffs get, which if you're 23 and you make a mistake with money, 24, you're going to make more money and you can make more mistakes and you learn from your mistakes. Athletes have one chance. If they mess it up, which is real easy to do at a young age, they don't get a second chance to make $20 million when they're 40. They're making it all up front. They have no margin for error. Where everybody else, there's a margin for error. You make a mistake in your 40s, you can still recover. You can't do that as an athlete. So, because your earnings potential, in which we'll get into in a minute. So get a mentor. Find somebody who knows how to walk through this process. Whether if you win the lottery, get an attorney, get a financial advisor who knows how to deal with this. Find someone you can bounce ideas off of that is responsible, that you trust. If you're a basketball player, find another successful basketball. Find Magic Johnson. Talk to him. This guy has been enormously successful, where he's helped out inner city youth. He's started businesses. The guy is, magic in his name. Like he's a magician. The things he's able to do after he got done with sports is amazing. So find a mentor. Find somebody who made that successful leap into the next world, and talk to them and have them help you come up with good skill sets and good mental models. The second thing he said is educate yourself. When you're 23, you're an idiot. We all are. So educate yourself. Become financially savvy. Don't feel like you need to spend all your money up front. Spend time. Don't touch the money for a year. Stick it in a bank account. Earn whatever, not a bank account, but stick it somewhere where it's safe for a year, and teach yourself before you even touch it, right? The money's still going to be there. The third thing, use your celebrity for good. Now, this for athletes is a big deal. For the rest of us, if you win the lottery, you're a 5-minute wonder. But use your celebrity for good. Use that to do good things in the world. You have lots of money. Help other people. I don't mean give the money away. That's a totally different thing. Good deeds and giving money are two totally separate things. But use your celebrity for good. Find a way to use that celebrity value to help other people, to find a cause that you like and you support. The fourth one is use your celebrity for business. One of the easiest things for professional athletes to do, and this is way back, and my dad used to tell me about this, there's a guy in town who did this, is you start up your own business. In local, if you're a local town hero, start up an insurance business. Everyone wants to do business with the hero. They want to say, oh yeah, I do business with that guy, or a real estate agent, or an attorney, or whatever your profession is. Start a business. People want to do business with successful people. So that's a great way to leverage your success into something else successful without actually having to use your money, right? You don't even need a lot of money to do this, but you can get clients and you can grow your business quickly because you're a celebrity. So use that. You don't have to work at Home Depot because you lost all your money or you weren't responsible. Use your celebrity for good. Find a way to use your celebrity. It doesn't have to be sponsorships or sneaker deals. It can also be your local town where everybody knows you and likes you. And the last one is work hard. Just because you won the lottery, it doesn't mean you have to just, cash it up, go sit in a hammock and drink margaritas all day. Find a way to be a functional human being. Doug talked about earlier on how wealthy people and on the problems that they have. When they become wealthy, they don't know what to do. They lack a sense of purpose because they don't need to work. So money basically, if you think of this, like we as human beings, we need challenge in our lives. We are workers. Like we need to do something. We need to get up in the morning and do something. That is part of the human being wiring. We need to be productive members of society, whatever that means to you. But you can't just sit around and do nothing. That's a good way to get depressed, to basically make have your life be useless. So when wealthy people, they have a hard time adapting to this. And the best thing you could do is just find ways to become normal, right? Go get a job. If you're worth $300 million after this, go get a job doing something. Just don't find a way to put challenge in your life that has nothing to do with money, because you're challenging yourself, your own human psychology. You're not challenging the money. You're challenging your ability to overcome things and to push yourself and to grow personally and professionally. These are all important aspects that if you win the lottery, you still need to keep this, because if you don't, you're going to find yourself very unhappy and depressed. And this is why a lot of people not only lose money, but also they become depressed, and their life doesn't turn out the way they want. So we're going to wrap it up. We can always come back to this, but there's so much more to this. We'll see if we get the lottery winner. Maybe we'll get them on the show if we're lucky enough. Either way, I'm going to wrap it up. Doug, where can people find more about you?
You can find more about me at procollegeplanners.com. Obviously, that's going to be a big expense for a lot of people coming into college planning season. And hey, I did want to just say one quick thing, because I know we're short on time, but it's interesting. We were talking about the NEFE, the research statistic on financial windfalls and bankruptcy. I actually published a disclaimer in 2018 saying, look, we know that there's something going around that we've attributed a statistic from us stating a 70% of lottery winners end up bankrupt just a few years after receiving a large windfall. They are actually saying that statistic was not backed by their research. It can't be confirmed. And that actually, based on what they're seeing, the majority of people that do get a windfall actually, or have a lot of money, do end up still better off in the future. So I think that's been going around. It's not necessarily coming from them, and they've actually tried to put out some press release to debunk that. Listen, if you get a lot of money, there's a lot of opportunities, but there are, as we stated today, there are some critical things you need to be aware of, because there are many stories of people who have unfortunately burnt through that money, and once it's gone, as we always say, money's gone forever. So again, if you want to learn more, if you're going to the college planning season, and as I said, you want to find more about how to pay for college, and listen, even if you've got the money, college is expensive. Be smart about how you pay for it so you don't overpay. Go to procollegeplanners.com, learn more, have a conversation with us. We'd love to talk to you.
Great. Well, thanks for coming on the show, Doug. And I'll have to look up that statistic, because I do remember reading something right off their website, which is why I put it on my blog post. It sounds like a little bit of whitewashing there. They don't want to offend people, but either way, that human nature is human nature, and whether it's true or not is irrelevant. People are human beings, and they're going to act in the way that they typically do. The point of listening to this episode specifically is to help you understand that, and to help you evade human nature and try to be responsible with your own activities if you're lucky enough to win. I'm going to go run out and buy 5 tickets right now, because I'm feeling lucky, Doug. So anyway, so that's the show for this week. Thank you again for joining Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast on the podcast app if you're choosing. You can check out our show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Also, please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a short rating and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're not selling any products or services, so do not consider this advice. If any problems with the show, I blame Putin, so please send him an email and express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe talk to a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. If you win the lottery, good luck to you. Give us a call, come on the show, love to chat with you. Either way, have a great week ahead. And remember, no one will care about your money like you do. So invest in your life.